ladies and gentlemen. Welcome to the Capital Financial Group Q3 Market Outlook video. Now that we have our technology transition behind us, we'll be doing these videos on the regular again. So if you like them, be on the lookout for them. Don't forget to like and subscribe to our channel so you don't miss any of our updates. So with that, let's get after it. We're going to jump right into U.S. markets. So far this year, the start of this year has been pretty darn good for U.S. stocks. At least the indices. This is a breakdown of the major indices that we use to gauge stocks. As you can tell right here, there has been a divergence in performance this year. While we saw last year, if you look back at the Q1 video that we did, the NASDAQ in particular was a horrendous underperformer. So far this year, it's been a substantial outperformer, most of that being driven by the AI narrative that seems to be all over the news into perpetuity. But in any event, still quite interesting. Most of the indices that we follow have done just reasonably well, whereas the tech stocks in particular have done exceptionally. I think it's extremely important to note that the lack of breadth in the market is really getting a little weird. I realize that's not a technical term, but I'm going to drop a couple stats on you here. Roughly 8 stocks in the entire U.S. stock market have driven 99% of the index total return so far this year. That is it, 8 stocks. Things are getting a little bit out of hand, quite frankly, so much so that one stock in particular, it'll take a quick Google search for you, but we're not talking individual stocks on this video for regulatory concerns. One stock in particular has a market cap that is larger than the entire Russell 2000 index. So before I go down a rabbit hole on this whole deal, I'm going to get back on track. Let's get internationals and emerging markets up on the screen here. They have improved quite a bit this year, kind of continuing the trend from the end of last year, something we talked about that we expected there to be some outperformance in that space. But as you can see, through January, both of these indices were performing admirably, but have pretty much done nothing ever since. But that's for good reason. At this point right now, we're seeing Europe essentially falling back into a recession, and then China, which is the largest constituent of the emerging markets index, has been slowing dramatically over the last, 2 to 3 months or so. Bonds have not bounced back as much as we expected at the beginning of the year. Once again, 3 major indices that we look at are displayed on the screen here. We have U.S. Ag, Global Ag, and then Munis. This is a 1-year look back. Just kind of wanted to show how extreme that trough was middle to late 2022. Pretty wild. We talked about it in our videos that we thought there would be a bit of a bounce back, and there has been, but on a total return basis, it hasn't been nearly as significant as the turnaround in some of the equity positions out there. Something else we discussed was potential outperformance for municipal bonds. That's signified of the blue line here, and that has actually come to fruition. So the munis have done quite well this year. There's a few reasons for that. If you want to get into it, give us a call or reach out at info@cfgfinancialplanning.com. Based on the research we've been doing so far this year, we expect there to be quite a bit of a shakeup here in the second half. I realize we didn't have the video for Q2, but a lot of this started to metastasize in Q1 and was exacerbated with some of the data we saw in Q2. Effectively, the combination, or I guess combo platter, if you will, of a profit recession, high interest rates, peak jobs, loan deterioration, lack of credit, student loan payments resuming. Oh yeah, those are coming back. Retail sales destruction, blah, blah, blah. I could keep going. All of these things together, we still expect a formal recession to be called, and it likely won't actually be called until it's already begun and really started to cause some issues. Essentially, I'd love to be wrong with this. I truly would. That would be fantastic for all of us. But the data at this point in time just does not at all justify us transitioning to a more bullish posture. As such, we're going to maintain the strategy of conservatism that we've at least employed so far this year and for much of last year as well. Our expectations are that assets need to reprice or earnings need to improve significantly. One of those two things absolutely has to happen. But either scenario does not necessitate significantly higher stock prices here in the United States in particular. This slide's pretty good. I think it provides a nice visual representation of how comically overvalued the S&P 500 is. The NASDAQ probably even more so, but this was the only one I could pull a chart on. The dotted line on this is a theoretical fair valuation. So, I mean, it's pretty easy to see that we got a long ways to go before we're fairly valued, but a few things could happen here. Like I said just a few minutes ago, finding reasonable pricing will likely require a combination of lower stock prices and improving earnings. That doesn't mean that we have to go all the way back to the long-term mean on price to earnings ratios. It's really not even that spectacular of a metric to focus on. It's just something that's easily understood and that's easy to visualize in charts like this. The good news is that specific sectors in particular have a tendency to hold up pretty well, and in some cases even do really well during challenging economic conditions like we're expecting. The bad news is that the stocks that have driven pretty much the entirety of the rally so far this year are not the sectors that do well in that environment, not traditionally at least. Here's a visual on how pure indexing might be a little bit problematic given the market breadth that we were alluding to earlier. If you take the 10 biggest cap stocks we have in the S&P 500 right now, and we give them a pretty color of blue, and then we do, I don't know, the lowest 85% of capitalization stocks in the S&P 500 here in orange, this is what it looks like in terms of total market cap. And because it's a cap-weighted index, the biggest issue you have is the big boys contribute massive amounts, whereas hundreds of other stocks do almost nothing to the actual index. So in this case, that's a weird thing because we could have a lot of stocks do really well in a rough or challenging economic environment. And then we could have a handful of stocks that are really, really big, not do so well, and the whole index would suffer from that. I think this is an opportunity for managing risk in portfolios, specifically through asset allocation and security selection, which we do through sector-specific strategies or country-specific strategies. In this case, continued focus on healthcare, utilities, consumer staples, and even defense companies. They have a tendency to outperform in these really challenging environments. And we're actually in the process right now of making some adjustments to those aggregate weightings in our portfolio strategies that we run here at CFG. You've already seen healthcare go in and out of the portfolio this year. Made small gains in those positions, which has been really nice. And it's been lagging a bit as well as some of these other select sectors that I was just mentioning or referring to. So if you haven't watched the video from Q1, that gives you a good idea of how we're still thinking, because not a ton has changed since then. At least our predictions in Q1 are very similar to what our predictions are going forward for the next 3 to 6 months, because everything has been slightly delayed over the last year or so in terms of the fallout from the interest rate hiking cycles, etc. So in terms of positioning, we totally missed the AI-fueled rally. We have a few positions that we've held in our individual stock strategies that have benefited from that. Obviously, some index exposure has benefited to some degree, but we were not focused in or targeted on that, and we missed most of that, and we are not even considering chasing it at this point in time. Rather, we're going to double down on our lower volatility and higher quality equity exposure here in the United States. Internationally speaking, we are going to focus on very select countries in the emerging market space. That will provide an opportunity to find countries that are doing well in an overly challenging environment that may theoretically benefit from slightly higher inflation, that maybe haven't seen inflation in a long time. A little bit of inflation can help growth in those types of countries. And we're going to try to stay away from, or at least reduce exposure in countries that are blatantly going into recession. At this point, that'll be relatively easy to do, only because these numbers are coming in hot and heavy right now, and the trends are becoming more and more apparent. Precious metals is something that will likely remain in the portfolio, at least for the foreseeable future, until we start to see their super cycle start to wind down. And then finally, in the bond space, we're looking at higher credit quality, as well as potentially extending out our duration or maturity exposure in bonds and fixed income. For more specifics on how all of this stuff is broken down, how it could apply to your particular portfolio, reach out to the team to schedule a review. If you're not a client and you would like a complimentary portfolio review, reach out at info@cfgfinancialplanning.com. If you like these videos, you find them helpful or useful, or at least piquing some interest, and you have some questions, please like and subscribe so you can get all of our content delivered directly to your inbox. Thank you all so much for watching, and enjoy the rest of your summer.